Choosing your investment style. Choosing your investment style plays a large role in your own personal investment goals. Earlier, we gave you some examples of investment goals, and you were asked to evaluate how well these goals directly aligned with your personal investment style. Now let's take a look at the different investment styles. Keep in mind, these are broad categories. Value investing. Value investing is a strategy that involves investing in stocks, or securities as a whole, whose shares seem to be underpriced. Value investors look for stocks that are on sale or priced lower than their intrinsic value. The intrinsic price of a company is calculated based on its fundamentals or information such as revenue, earnings, assets, liabilities, growth, and management. When the market realizes the mispricing, the market price will rise, netting the investor a nice little profit. Of course, the only way to really know if something is underpriced is by studying the financial statements, the competitors, and the overall market trends, which we'll show you how to do in a later chapter. Know what you own and why you own it. Peter Lynch. Growth investing. Growth investing is a strategy whereby an investor will seek out stocks that he or she believes has substantial growth potential. In this case, the investor has a strong belief that the company's income earnings will far exceed what their respective market predicts. These companies generally reinvest much of their earnings on projects that help the company grow and increase future earnings. Thus, growth investing is essentially investing in the future growth of the company. Some investors argue that both growth and value investing are fundamentally integrated with one another. Income investing. Income investing is a very common investing strategy. It involves the selection of stocks or other securities that will provide a steady payout. For example, stocks that pay out dividends, which is a fancy term for when a company pays you, the investor, a small amount of money per share that you own in the company on an annual basis. Basically, a way of saying thank you for holding their stock. Would be great for an investor whose investment style is income-based. Income investors also prefer companies with stable earnings so that their dividend yields are sustainable in the long term. I believe non-dividend stocks aren't much more than baseball cards. They are worth what you can convince someone to pay for it. Mark Cuban.